COVID-19 has now transformed into a global pandemic. It has affected our economies, our jobs, the stock market, and our way of life. As it brings uncertainty to many parts of our lives, this series is our conversations with the companies, the players, the decision makers, to help us make sense of it all. Welcome to COL Conversations.
Good afternoon, everyone. Welcome to COL Conversations. Today, I'm joined by Toti Bengzon, the CFO, Treasurer, and Chief Compliance Officer of Ayala Land, to share with us how Ayala Land is doing in light of the crisis and the lessons that the company has learned that you can share with us. So, Toti, thank you very much for accepting our invitation. I
My
guess I'll
pleasure,
start.
April.
Yeah. So I'll start out by asking you, given the ongoing COVID-19 pandemic, how is Ayala Land doing? How are your different sectors doing?
Well, I guess it's a question of is the glass half full or half empty, depending on how you look at it. As the CFO of Ayala Land, as long as the glass is filled with vodka, then it's okay, either way. But
Yeah.
as you know, this pandemic has hit the company and the rest of the world quite hard. This is unprecedented, and it's taken a toll not just on lives, but on livelihoods as well. So it's been quite a challenge. And the reason I said it's glass half full or half empty is if we compare where the company was, say, a year ago, or how we performed over the past 10 years, then clearly the situation is not good. But I guess relative to most other companies, especially in the property sector across the world, you could say that the company is in good shape.
Okay, so maybe we can go to the different sectors. Like maybe we can start with the worst hit to the most resilient. And how does that compare to what you initially thought in March?
Yes, the lockdown occurred mid-March, and we were all, taken by surprise as to the severity of the situation or the severity of the impact on our leasing assets, in particular our malls. Well, clearly, during the quarantine period, the malls were not allowed to operate, so revenues went to zero. Well, not exactly zero because a few of the essential merchants, those selling food and drugs, were allowed to operate, but for most other merchants, they had to close. And that continued all the way for the greater part of the second quarter. So in terms of the malls business, it's been hit quite heavily. Our hotels and resorts, similarly, as you know, leisure travel as well as business travel has pretty much ground to a halt. So our hotels and resorts have also been impacted by the virus and the resulting community quarantines that have been imposed by government. Offices, surprisingly resilient, given that BPOs in particular, which account for close to 80% of our total portfolio, remained open. They continued to operate, and so they continued to. We've continued been able to continue eking revenue from our office portfolio. Residential, I think, which we expected to be hardest hit. As you know, we've been telling our stakeholders that the property development is a very cyclical business. I think many people have forgotten that, given that over the past 10 years, the company has grown by leaps and bounds. If you look at the company's bottom line, over the past 10 years, from 2009 to 2019, it's grown at a compounded annual growth rate of 23%. Our share price has appreciated by 15% compounded over that period, against the Philippine Stock Exchange Index's 10% compounded growth rate. So the company has done exceptionally well in the past 10 years, and people may have already been thinking that it'll continue to perform that way. But we've been saying that property development by and in itself is a risky business, and it is prone to cycles. So we had actually embarked on a strategy in 2014. It was a strategy to ramp up our leasing business. In other words, to expand our leasing portfolio so that we would be able to generate recurring income, which would help us get through these cycles. And we've been able to grow the leasing business significantly. But as it relates to our residential business today, it was quite surprising. The residential business continues to be doing okay despite the lockdown. It's running at about, I would say, roughly 60% of where we were last year. So in other words, despite the situation we find ourselves in today, uh, the residential business continues to perform, and that's why I mentioned at the start. For Ali, it's half full, half empty. We've got sectors that are continuing to do fairly okay, and other sectors that are not doing so well. But these are all on account of the pandemic. Everybody's in the same boat, and our other emphasis, what we've been talking about the past couple of years, is we're here for long-term growth. The company is we're running the company for long-term growth. We're running the company to ensure long-term value creation, and we believe that we've positioned ourselves. We have a balance sheet and assets that will continue to appreciate over the long haul. So this is a temporary setback, albeit quite a severe setback.
Yeah. Just wondering, I mean, surprisingly, no, I remember in early March, we were really anticipating even the office sector and the residential sector to be hit. So did you have to say, cut lease rates, or for the residential, did you have to cut prices?
But for offices, we haven't had to reduce lease rates, and that's because we've ensured that all the offices that we lease out are operational. So the facilities are open. They're staffed by the property managers as well as the maintenance teams. Aircon, the common facilities are all operational. So anybody who was leasing from one of our offices would be able to use it if they deem fit, if they wanted to use it, and the BPOs continue to operate. Residential, I think, is something that's a bit surprising, given that we've always thought that that would be most prone to any downturn. Uh, it's surprising in the sense that our sales force were able to continue to sell, and as I mentioned, we're back to about 60% of where we were in the previous years. If we take out the launches, as you know, we've curtailed our launches. We launched close to 160 billion worth of product last year. We only launched about 5 billion at the start of this year, and henceforth we will not be launching new product because we have enough inventory. So our sales level today is roughly at about 60% of where we were last year if you take out those launches. As you know, when we launch a product, there's typically a surge. So if you remove that surge that we experience when we launch, we're running at about 60% of what we would call the steady state.
Yeah, that's quite amazing actually. But one of the things that, well, as far as I'm concerned, one of the this time it's different theme is the low interest rate environment. So has Ayala Land been capitalizing on the low interest rate environment and through fundraising and the likes?
Yeah, the definitely low interest rates have been supportive of asset prices. So I think what makes this crisis different from previous crises that we've experienced, which were primarily financial in nature. low interest rates, both interest rates as well as an appreciating or a stable peso, have been supportive of real assets as well as financial assets. Um, in the case of Ayala Land, we benefited from the low interest rates that really began, say, 2010 onwards, wherein we saw the 10-year benchmark hit single-digit levels. That's been very supportive of our business. Mortgage rates have continued to trend down, and right now they're quite stable. So this has made product for most Filipinos affordable, given that lower interest rates coupled with longer tenors, which the mortgage banks continue to offer, have made the monthly amortization affordable. So low interest rates have been beneficial to the property sector in general. In the case of Ayala Land, we've taken advantage of the situation by continuously strengthening our debt portfolio and our balance sheet. And what do I mean by that? As far as our debt portfolio is concerned, we've stretched out maturities. Average maturity of our debt portfolio stands at about 5 years. We've locked in and continue to lock in most of our debt in fixed rate. Our target is to achieve at least 90% of our debt portfolio locked in on fixed rates. And of late, the recent downtrend in rates, we've taken advantage of by undertaking refinancing, active refinancing activities. So we've already refinanced about 15 billion pesos of debt that were relatively high priced. And high price for us, or high cost for us, was an interest rate of 6%. So that's not that high, but for us, it was one of our higher cost debt. We've refinanced that. We were able to issue a 2-year bond in June. I believe we were the first corporate to issue a listed bond during the pandemic. We were able to raise 10 billion of a 2-year fixed rate bond at a coupon of 3%. So quite attractive. And currently, we are in the market. We've launched our second debt capital markets transaction. We are looking to raise a minimum of 5 billion with a 5-year tenor. So it's 5 billion with an oversubscription option of another 5 billion. And we've got 5 of the domestic underwriters to assist us in this initiative. So we're looking to get that issued and listed sometime in September. So that will be another 5 to 10 billion. We've taken advantage of the lower rates to refinance, and it's what it's shown. The fact that we've been able to go to the debt capital markets is that the company's liquidity needs are fully satisfied, not just by the debt capital markets, but even the banks. As you know, we have access to both the bank market and the debt capital markets, and it's proven to be beneficial for the company. There are times, for example, at the start of the pandemic, where bank lending rates were higher than what we could get from the debt capital markets. So we've gone to the debt capital markets for most of our refinancing requirements. So at some point, it may reverse. Then we have our credit lines with our banks available for us. So as far as liquidity is concerned, that's been the priority for Ayala Land. When the lockdown occurred, the first priority was to ensure that the company had sufficient liquidity to allow it to weather the storm. So today I can confidently say we have more than enough liquidity. Access to credit is unimpeded. And with some of our businesses continuing to pull through, coupled with our cost containment initiatives, we should have more than enough liquidity to ride out the storm. And we're even looking at potentially paying down debt within this year. We're targeting to reduce our debt levels to lower than what we ended 2019 with. So that's another way we're sort of strengthening our balance sheet, making sure it's strong enough to ride out the storm. We don't know how long this storm will last. So best to be conservative, as we've always been. We want to make sure we can ride this out for as long as it takes.
Yeah. So, I mean, aside from that, you have the REIT listing that is coming up. So, I guess first of all, how will it benefit Ayala Land, the AREIT listing that's coming up next month? And for the retail investors, do you think it's a good idea for them to invest in AREITs?
Definitely. This has been a long time coming. The REIT's been in the works for over 10 years. And I remember way back in 2008, the company, Ayala Land, we were already preparing to REIT because we believed that the product would be both beneficial for the issuer, Ayala Land, as well as for investors. So let me start off first with the benefit to investors. Effectively, we're creating a new asset class that will straddle the spectrum of risk and return between equities on one hand, relatively higher returns, high risk, and bonds, relatively safe but lower returns. REITs will be somewhere in between. It will be listed, so it will trade. There will be a market for it, and there will be some potential for capital appreciation, given that the assets in it could appreciate, and the cash flows that are resident in the REIT could continue to grow. So the REIT will be in between. So it gives the investor a good investment instrument, one that generates regular dividends and regular cash flow, while at the same time it provides for some potential for capital appreciation. So I think the investors, a lot of investors will benefit from a REIT market being established in the Philippines. So I encourage all your viewers to consider investing in a REIT and the other REITs that will be forthcoming. So when you invest in the REIT, you're actually buying into, and I'm talking about the A REIT, you're buying into grade A office buildings of Ayala Land, that Ayala Land has developed. So these are 3 buildings that we have here in Makati in the business district. You've got Solaris, about 46,000 square meters of gross leasable space. Ayala North Exchange, the 2-tower development where we have office and on which a SEDA residences is stacked with some retail on the podium. And then we've got McKinley Exchange at the corner of EDSA and McKinley, where we've got about 10,000 square meters leased out to a BPO. So these are grade A offices with an excellent tenant base. So we expect these assets to continue to improve with time, given that the lessees have locked in on long-term contracts, which provide for anywhere between 3 to 5% rental escalation year on year. In addition to these 3 assets, the proceeds from the primary share offering will be used to purchase another building in Cebu with about 17,000 square meters of gross leasable space. So expect that the REIT will have close to 170,000 square meters of gross leasable space in that REIT within the year. So that will, given that these offices are close to 99% leased out, with provisions, long-term contracts in place that provide for rental escalations, then the net operating income of the REIT should be quite healthy, and that will in turn allow it to declare dividends. So I think the target or the estimate for the first year is a dividend yield of anywhere between 5.5 to 5.8%, which when compared
That's 20, yeah, that's 2021 or 2020.
5.8% by 2021.
Okay.
That compares, or that's quite attractive relative
Yeah.
to where bond yields are. The 10-year bond yield is at 2.8%.
Yes.
If Ayala Land were to issue a bond, that would be roughly about 3.8%.
Yeah.
So this one gives you a 200 basis points pickup versus a AAA rated corporate bond. At the same time, the withholding tax or dividends for individuals is lower. It's 20% for fixed income instruments and 10% for the REITs dividends for dividends.
Yeah. Are you going to be consistently paying more than 90% of the
Well,
distributable income?
the regulation is to provides for at least 90% payout
Yeah.
of what they call distributable income. So we will do that.
Mm-hmm.
Now, you asked me about the benefits to the company. Then clearly, in our case, we'll be raising from the secondary proceeds close to 11 billion, and
Yeah.
coupled with the oversubscription option, the green shoe, another about 1.2 billion. So close to 12.2 billion to 12.3 billion will go to the company, which we will deploy and fund our other projects so that we can continue developing quality assets. Ayala Land will be the developer, and the REIT is where we will be putting our relatively more mature assets. So again, now your investors will have a choice. Do you want to take higher risk, higher return on equities? You have the Ali share, which will give you, which is the developer. If you want something more conservative, then you go to the REIT, which will provide you with a regular dividend stream. But the upside of the capital appreciation will not be as aggressive or as strong as what you would find in a property developer, a listed property developer.
Okay, so I guess the question is, well, one of the questions I get is, how will AREIT grow? Will Ayala Land be injecting more assets? And will this be, I guess, only be offices, or can you inject hotels or malls in the future when the time is right?
The other benefit of this REIT to investors is that it's backed by a sponsor like Ayala Land. So we do have a pipeline of assets that we can seed into the REIT, and that will allow the REIT to continue to grow. Ayala Land is committed to growing the AREIT. For now, we've injected office assets. In the future, we could inject other commercial assets. That's possible. But definitely, you will see the growth, or you will see this REIT growing in the future. The sponsor, Ayala Land, is committed to ensuring the success of this REIT.
I guess there's also a question, will you be listing another REIT, or will all the commercial assets be injected in a REIT?
Well, for now, we're just looking at this AREIT as our vehicle. There's been a long debate internally, and we've also discussed this with our investment bankers. Is there still a preference for thematic REITs, like what you see in other jurisdictions? I think given that the REIT market in the Philippines is relatively is new, I think our objective today will be to ensure that the REIT grows in scale. I think it's also important that you achieve a certain scale. One of the benefits of achieving scale is you get automatically included into the REIT indices. and that ensures that you attract these large passive funds into your shareholder registry. So I think at this stage, we'll grow the REIT first, and then we'll start thinking about whether we should come up with thematic REITs, separating different leasing assets in different REITs.
So I think one of the controversial areas about AREIT is the decision for Ayala Land to keep the ownership of the land. Can you explain to us the reason for this, instead of injecting everything into AREIT?
Yeah, at least for the assets that we've put into the REIT, land was not included. But we've said that it does not preclude us from including land in future assets that we inject into the REIT. For these three assets at least, and the fourth one also being the asset in Cebu, land was not included, primarily because we wanted to ensure that the dividend yield would be attractive. For you to be able to give an attractive dividend yield, you need to make sure that you have the cash, and it's also determined by the valuation of the asset. If we had valued and included the land, then the value would be quite large, and the income being generated by the assets would not be able to hit the targeted dividend yield of about 5%. We also note that in other jurisdictions, in more developed REIT markets, land is also not included. Singapore and Hong Kong, typically what you have is a leasehold. The building or the structure is constructed on leasehold. And what is important, and that's what we made sure of, is that these leaseholds are long tenor. So in the case of the assets we put in, I think the land lease runs for about 34 years. So it's quite long. And that once that lease expires, then I'm sure the sponsor will be thinking of the highest and best use of the property, and there could be a redevelopment or just a refurbishment of the asset, which of course the first candidate to continue holding on to that asset would be the AREIT. So I don't think land ownership is critical in a REIT. What's important is being able to generate cash flow that translates into an attractive yield for the investors.
Yeah. So going back to the COVID-19 crisis, what lessons have you learned from it, and how will it affect Ayala Land's strategy going forward?
I think one lesson or something that has validated our strategy, I think, is the importance of a diversified portfolio. Okay. So your investors, I'm sure they have some in equities, property, some assets in financial assets, real property assets. In our case, we're a diversified property company. So we've got residential development, office condominiums for sale, commercial lots for sale. So that comprises our development business. We also have the more stable part of real estate development, which is developing and operating leasing assets. So we have malls, offices, hotels, and resorts. And in addition to these two engines, we have a third leg, which is real estate services. We own the largest construction company in the Philippines today, Makati Development Corporation, as well as the largest property management company, APMC, Ayala Property Management Corporation. And we cannot underestimate the value that these service businesses have provided to ensuring that we have quality assets, both on the development side and on the leasing side. So all these various businesses contribute, and there's synergies that we're able to achieve. And as you've seen in this crisis, which was completely unexpected. I don't think we expected that there would be one crisis that would hit the entire world across the board. Everybody would be affected. And the fact that we had different engines within Ayala Land allows us to continue to thrive. So the malls, which we thought would be the most stable business, has been affected, but residential, offices continue to operate, and we still have revenues coming in from those segments. So a diversified portfolio, I think, is something that is very important. And in addition to that is the importance of a rock solid balance sheet. So we've been accused many times of being too conservative as far as our financial policies are concerned. I think this is one time where it shows that it really makes sense to err, if ever, on the conservative side. So we've always been conscious of our balance sheet, making sure that we don't get ahead of ourselves. Interest rates have been quite low for the past decade, so it's actually been quite been very attractive to lever up. But we've purposely made sure we stayed well within what we consider to be the upper limit. We've always said that we're comfortable to leverage up to a net gearing ratio of 1:1. We've never really come close to that. Our creditors allow us to go up to a net, not a net, but a gross debt to equity ratio of 3:1. By the way, that's the only financial covenant we have, and that's from our primarily from our banks. We're allowed to go up to 3:1. We've never gone close to that. And then over and above that, we made sure that the debt portfolio was, protected, longer tenor, more on the fixed rate side, even though it at some point it was costing us a little bit more. That's all turned beneficial for us in this crisis. And I think the third point would be the importance of having a dedicated and committed workforce. We're very fortunate that the Ayala Land family has remained committed. We've got close to 6,000 organic employees across the group. During this crisis, we've not undertaken any manpower reduction initiatives. As a matter of fact, when the lockdown occurred in March, mid-March, we still provided our employees with their bonus from 2019, that from their performance in 2019. We didn't cut back on that, and we also provided them with their 14th month pay, knowing fully well that they needed to have some a level of comfort, because they could have other members of the family who would be relying on them during these difficult times. But over and above the immediate Ayala Land family, we also supported our non-organic employees, close to 70,000 of our contractual workers. We provided them with we committed to provide them with close to 600 million pesos of financial assistance to get them through, to tide them over until things normalize. And as far as our stakeholders are concerned, even our mall merchants, I think we condoned rent to the tune of 4 billion pesos, and that covered the period mid-March up to end May. So the Ayala Land family, which is comprised, our immediate family being our employees, we've taken care of them, and we've expanded that to our extended family of our other stakeholders, be that the non-organic employees, our suppliers, and our merchants and our other customers. So I think these are the three key lessons that we've learned during the crisis.
Yeah. What about going online? Is that something that also affected you or benefited Ayala Land?
sorry, going
Like
online.
an online presence. Is that something that has benefited you?
Well, digitalization has been one of our core initiatives in the past 4 years now. So we moved to the cloud in 2017. Uh, just last year alone, we had close to 100 digital initiatives, of which we completed half of those. Um Certainly, digitalization has allowed us to weather this crisis much better than those who haven't digitalized. Case in point was when the lockdown was imposed. Uh, the company, on the very first day, March 17, I remember that day clearly, everybody was on Microsoft Teams. And so we were all working and collaborating online. So it was like business as usual. We were able to reach out to all our employees, get everybody aligned with at that time, we launched the 5 point action plan. And it was like we didn't skip a beat. Our customers have also benefited from our digitalization initiatives, especially on the residential side. How were we able to sell? It was because we had digital channels that allowed transactions to be consummated. We had put in place payment channels, which were digital. So typically, you get payments through post-dated checks. Aside from that, we had already expanded that to what we call auto debit arrangements, where there's a debit authority that's issued to a bank, and the bank just debits the customer every month. So in that way, even during the lockdown, we were getting cash into our coffers. We've allowed our customers to make reservations using credit card, and we tied up with some of these fintech companies, for example, QuickWire, that allows customer to effect payment online. So digitalization, we've been on it for several years, and certainly it's helped us, and expect us to roll out more digital initiatives. I think you've probably heard of the malls rolling out its own
Yeah.
app, Zing.
Mm-hmm.
They've also launched drive-by, and some other. I think it's Pashal.com, which showcases some of the products that you can find in the mall. So expect to see more of these initiatives across the entire Ayala Land group.
Okay. Any closing thoughts?
I recently came across this study. It was released in 2017, and it's quite interesting. The Economist frequently quotes from it. It's called the rates of return on everything. And so it was a study done by economists from the University of California, the University of Bonn, economists from the Federal Reserve, and the Bundesbank. And it looked at a 145-year period, and essentially tracked the returns in various asset classes. And the findings were quite surprising. So the main asset classes they looked at were real estate, property, primarily residential real estate, residential housing, equities in different markets, bonds, and treasury bills. And quite surprising, the highest return over that 145-year period was generated by investing in real estate. On an inflation-adjusted basis, the average return for real estate was a little over 7%. In second place were equities at 6.9%. Then you had bonds at 2.5% and bills at 1%. So this was a study conducted across 16 of the developed markets because they have the track record and the data. But the other benefit, aside from generating the relatively high returns, is in real estate, you don't have the same volatility as you would encounter in other asset classes. So, tying that to Ayala Land, we've always believed that the company is here for long-term growth. We want to ensure the value is created, and we're looking at long-term. We have a long-term outlook, so we're quite confident that this pandemic notwithstanding, the company will continue to thrive, and that the assets that we put out will provide our investors with probably the best returns over the long haul.
Yeah, that's an interesting, closing thought. Now I think I have a dilemma of whether to buy Ayala Land shares or to buy Ayala Land properties. Or actually, you can buy both.
You should do all three, including the
And
AREIT.
even the REITs, yeah. That ends our COL conversations with Ayala Land's Toti Bengzon. Thank you very much, Toti, for joining us today.
Thank you, April. Thank you for allowing me the opportunity to share with you, your clients, as well as your viewers, to share with you the Ayala Land story.
Okay, to our viewers, thank you for joining us in today's episode, and see you next time.